Hey investors, thank you so much for joining me. My name is Michael from Deep Value Returns, Seeking Alpha. Today I want to talk about Zynga. Zynga is about to be acquired by Take-Two, and I'm going to go through that and why I believe that the investors actually should really look to exit this position right now. So we're going to go through and highlight, how thinking about the stock right now. So as I'm talking about it right now, the stock is approximately $8.50, and why this is a reasonably good time to just, call it a day here. So here's the thing, right? The stock has had been kind of falling for several months. So since the summer, there's been this continuous sell-off. So back in June, I'd written about Zynga, and I said that it's difficult to make the case that the stock is dramatically undervalued. If we take its EBITDA figure, presently the stock is trading at approximately 27 times forward EBITDA. This is not particularly attractive for a company with a valuation with unimpressive growth rates. So since that time, the stock, when I wrote about that, the stock was at $10.29. The stock had sold off, and in this 17, this negative 18% includes some of that appreciation that happened yesterday in the stock. But if we take the full value of the deal at the time of the deal, you still would have come out negative 4% since June, which is not great, right? But then in October, I had revisited the Zynga, and I had a new valuation, and I said that Zynga's priced at 12 times next year's revenues. This isn't expensive by any stretch. At the time, it was $7.55, and the share price, including the appreciation yesterday, is up approximately 12%. Now, there's some more upside here to be taken. If you want to risk that, if you kind of want to hold out until the deal the deal completes. But Wedbush security analyst came out and said that he believes that the deal is a bargain, and I don't believe that it's quite a bargain, right? So since I was able to actually have a good grasp on this, and I recognize that even a monkey throwing um, darts can be right occasionally, but I believe that since I was able to call it both above and below, so the two sides of the equation, I think that that kind of gives me more validity than someone else that probably just speak in their book really. Um, so here's the thing, right? The revenue growth rates were fizzling out. And anyone looking at the stock say, no, Michael, you don't get it. Like Q3 21, they were up 40%. How is that fizzling out? The problem is that they made the acquisition of Peak in Q3 2020. So as they lapped that large acquisition, the growth rates are going to fizzle out. They were guiding for 10% approximately for Q4 and low double digits for 2022. So with that in mind, I mean, it's for a business that is in the mobile industry and should be mobile gaming industry and should really be taking the opportunity, because everyone talks about the mobile industry is supposed to be having approximately 8 to 9% compounded annual growth rates of expansion in the total addressable market. So everyone else is making so much money here. Zynga kind of was just being really not benefiting that much, and it should be, but it isn't. Anyway, so the thing that the problem with Zynga's revenue growth strategy is that it had to always require it always to make large needle moving acquisitions. So those needle moving acquisitions have a few problems. First, they have to be large enough to actually move the needle. Second, they're costly. Thirdly, they're risky, right? Because you never know how the new management coming in, if they're going to be able to integrate that well, and it's always really time consuming. So with that in mind, I mean, it's a difficult strategy to embrace, and it's costly, yeah. So the thing as well is that when I look at Zynga, so they talked about that after Q1 2022, so the upcoming quarter, after that they had paid out most of their earnout commitments, and they were able to leverage their cash flows to make further acquisitions. The problem being that its balance sheet already was in a net debt position. You can see here it had 1.3 billion of convertibles outstanding, so it wasn't a nimble balance sheet anymore. So with that in mind, that was going to meaningfully hinder their ability to find something that really kind of would ignite that revenue growth rate, because those really high quality businesses don't come that cheaply. And so this is why I believe that the acquisition makes sense. So if you consider this, right? So the Zynga, on the headline talks about, oh, together with Take Two, we're going to have 500 million of synergies over time. But in actuality, they're only talking about 100 million in synergies over the next 2 years. Think about that, right? So for an enterprise value that is going to be more than 20 billion, for them to have just 100 million of synergies, I mean, it doesn't give them too much. It's what you see is what you get. So it's practically a rounding error. And I believe that the biggest takeaway here is that, if you look here, I'm not sure you can see properly, but the CEO, I think the CEO, Frank Gibo, hopefully I'm pronouncing that correctly, had less than 1% equity in Zynga. So I know that he got a lot of stock options over time, but he was getting those stock options and selling those stock options, and there wasn't a lot of skin in the game. And that's the thing, right? So if you're going to buy into companies, try and buy companies where management has a lot of skin in the game. They're really, really motivated. It's their baby. They're really going to see it through. And that wasn't the case here. And the second takeaway here is that if you decide not to buy into companies that have a lot of where management has a lot of skin in the game, do make sure that you're really, really price sensitive. And that's what I tried to highlight here at the start of the article, that in June, I kind of said, okay, I don't see a great opportunity here. Then in October, I revisited the new valuation when the stock had sold off meaningfully, said, okay, that's not really expensive by any stretch. And yeah, so I hope that you found this quite instructive. And yeah, so the biggest takeaway here is, the share price right now is at $8.50. Obviously, that's slightly less than the announced deal of 986. But for you to get the 986, you're kind of having to assume that the 2/3 of your deal, which is equity in Take Two, that Take Two is going to be able to come back up because it has also meaningfully sold off in the last several days. Even before the announcement of this acquisition, the share price had been tanking as well. So you have two options here. Option one is for you to kind of stay put and hope that Take Two, and you're going to be in kind of quote unquote investing in Take Two essentially, and you're going to have to hope that that share price goes back up. Or option two, you just kind of, okay, call today, take the $8.50. That's what I personally would do. Because I think I think that irrespective of what other people are saying, ultimately you have to be independent thinking. And in this event, I think that this is a really reasonably good deal by getting $8.50 for Zynga. So yeah, I hope you found this useful. Don't forget to check out my marketplace if you want to find what kind of stocks I'm buying right now, where I offer you high quality, actionable investment ideas. Yeah, and thank you so much for listening.